We believe those stocks have basically outperformed the market by about 400 basis points per year on average, with below average market volatility. There's no one who is naturally inclined to own these stocks. The market has become very, very short-term focused, right? You have so many investors who are trying to outperform, not over 1 year or 5 year or 10 year. They're trying to outperform over every week, every day, every month. If more investors are making decisions based on, hey, I want to own more financials, as opposed to I want to own more JP Morgan or I want to own more ICE, there's more inefficiencies, right? Amazon trades at a discount to Walmart today, which again, makes no sense whatsoever. Tesla could fall 95% tomorrow and I wouldn't buy a share of Tesla. We do think AI will be disruptive to the economy. I think long term, 5, 10 years out, AI will likely cause the unemployment rate in this country to be structurally higher. I've heard a lot of people talk about the Fed. I don't know if I've ever heard anybody say something about the Fed that actually ended up creating value for shareholders.
David, thank you very much for joining us on Excess Returns.
Thanks for the invitation. I'm glad to be here.
You are head of investment strategy and CIO at Rowe Price Investment Management and also portfolio manager of the Rowe Price Capital Appreciation Fund, a 5-star fund according to Morningstar, and also you manage the Capital Appreciation Equity ETF. This is a pretty incredible stat, I think, in the investment management world. So the Capital Appreciation Fund has outperformed its Morningstar peer group for 17 consecutive years through the end of 2024. And that in of itself is just impressive. But a lot of times in investing, outperformance and billions of dollars don't really go well together, and they can sometimes counteract each other. So the fact that the fund has done that at its size is just an incredible accomplishment. And those are really some top shelf returns over a long period of time, over many different market environments. And that's why we're excited to have you on, so we can get your thoughts on the market, talk about your investment process, the way that you construct portfolios, and what lessons investors can take away from your approach and your philosophy. So again, really appreciate your time. This is going to be great.
Looking forward to the discussion today. Thank you.
So to start, I kind of want to, I'm sort of jumping right into your investment, philosophy, if you will, on the equity side, but I thought this would be a good place to start. So you describe your stock selection approach as a GARP sort of focused approach, which is growth at a reasonable price. So what does growth at a reasonable price mean to you today? And has that definition evolved over your career in any way?
I don't think it's evolved that much, but I think when you think about a GARP stock, you think about a company that kind of grows revenues kind of that mid-single digits, maybe some companies in the kind of the higher end of the mid-single digits, produces a little bit of margin, it does good cap allocation, can kind of generate, let's call it a low double-digit algorithm over time, tends to have very limited cyclicality to it. These companies today in the S&P 500 make up about 13% of the S&P 500 today. But if you look at over my investment career over the last 19 years, we believe those stocks have basically outperformed the market by about 400 basis points per year on average, with below average market volatility. And so why does this inefficiency kind of exist in the marketplace? It's if you think of all the different actors in the market, there's no one who is naturally inclined to own these stocks, right? A value manager might look at a company and says, hey, it's a great company, but I can buy banks at 11 or 12 times earnings, and I can't pay 18 or 19 times for some of these great companies. A growth manager might say, hey, I only want to buy things that are growing double digits on the top line organically. Well, that doesn't fit these companies. A hedge fund's very, very focused on maybe trying to find a company that's really volatile and making a call in the quarter per se, right? And a retail investor really doesn't know these companies that well, right? They're not. It's not like McDonald's or utility or Tesla. These are companies that most people just don't know, right? So because you have this supply-demand imbalance for these GARP stocks, you're able to buy these great companies for very, very low valuations. And over time, usually the valuations expand. We've had a lot of companies where the valuation started off at one point and then valuation expanded over time. So you can kind of get the double whammy of kind of, let's call it a low double-digit algorithm, which will beat the market in most years. In addition, a situation where the multiple tends to go up rather than going down. And with great risk-adjusted returns. So if you look at our portfolio, I said the market's basically 13% kind of GARP stocks today. We're about 30% in all of our portfolios, GARP stocks, under our definitions. We do more than GARP stock, but that's a big overweight. And again, it's worked out well from a risk-adjusted return over time.
Yeah, I guess there's no GARP square in the Morningstar style box. So that's why those stocks maybe are a little bit less noticed.
No, that's exactly. Actually, you joke, but that's actually probably why. There was a GARP index. There'd be a lot of people who would try to beat that index. So the fact there's not an index actually creates this inefficiency for us.
We were in preparation for this podcast. We were looking at some of your thoughts and insights from earlier in the year, and I think you were somewhat cautious on sort of the return potential and your outlook on the market. So can you kind of just talk to where you are today?
Sure, it's been a kind of a roller coaster year in terms of thinking about that question, honestly. So we did start off the year being pretty conservatively positioned in the portfolio. We tend to about 500 bips underweight our equity exposure in the strategy coming into the year, and that was really a function of we do this bottoms up S&P 500 analysis. It's a 5-year look forward for the market returns. It's actually looking at individual companies and a couple sectors that are more correlated, if you will, like energy and staples and utilities, and kind of looking at what we think every company, every sector should trade for from a multiple perspective. Doing, again, a bottoms-up analysis. And when we do that, we kind of got to, at the beginning of the year, I think at the peak of the market, the forward return for the next 5 years we thought was going to be less than 5%. Market returns less than 5%. You're getting kind of 6% kind of yields and high-quality, high-yield leveraged loans with much lower volatility, want to overweight kind of those asset classes over equities in this environment. Now, again, fast forward, basically a month or two ago, right? We had a situation where the market fell almost 20% peak to trough, and we went overweight equities. We went from being 500 bips underweight equities, being 200 bips overweight equities. Again, because that 5-year IRR analysis we did for the market went from 4.8% to 9.5%, and again, the IRRs our individual names are typically, let's call it 400 bips higher than that of the market. So at the trough of the market, we were looking at a portfolio filled with IRRs within the CAF and the TCAF products in the mid-teens. And some companies like at the trough were in the 20s. So we were doing that. And again, as the markets recovered, we pulled back the exposure. The forward return on the market next 5 years is about 6%. We do that analysis once a year. We'll update that analysis probably sometime in June and July of this year. But as of the analysis last year, again, kind of forward return, kind of 6%, not as low as at the peak, but not as attractive as the market bottom where we were. We put $2.4 billion to work one day in the equity market the day before the market troughed.
I want to ask you about tariffs, but before I do, I'm just curious. I mean, obviously, you're trying to take advantage of those lower valuations, but do you get surprised when you see moves in the market like we've seen? You can always tie back to the why in hindsight. Like with COVID, with the Fed and the stimulus and all that came into the market, we can look back at it and say, wow, no wonder the market ripped. Or in the current environment, we've seen this 20% move off the lows. As a professional investor, are you still surprised, or is this something that you've kind of come to say, markets are just going to do what they're going to do and nothing really surprises me anymore?
Well, I think one of the crazy things with the market that we all live in, and this is probably, I got into this business back in 1998, and the market has become very, very short-term focused, right? You have so many investors who are trying to outperform, not over 1 year or 5 year or 10 year. They're trying to outperform over every week, every day, every month, right? And what happens a little bit is if stocks are going down, there's just a gravitational pull for people to sell, right? They're not willing to kind of have a little longer time horizon, right? They're trying to maximize compensation, maximize performance on a very, very short-term basis. And I just think that's a losing strategy. I think it's a losing strategy. Again, the reason why we were buying stocks hand over fist when the market was at 4,900 was not because we had a great visibility that the next day was going to be the bottom. We had, but we had to say, hey, if we buy these stocks today, and we have a 1 year, 5 year horizon, we're going to make a lot of money for our clients. We're actually, at the bottom, we thought we could actually double our clients' money in our equity sleeve in the next 5 years. So many investors are just, that's not their mindset, right? It's feels bad, uncertainty. That's just one of the market inefficiencies that we're trying to take advantage of, that longer term horizon that, again, so few investors have today. So it's very, very easy for us when markets go down to do the opposite of what most market participants do and actually add to equities because we have that longer term horizon. And again, you reference the 17-year streak. It's kind of funny, kind of counterintuitive. We have this long term horizon, but actually, again, counterintuitively, it actually aids short-term performance. Because like we're all in at the bottom. We were all in at the bottom of COVID. We're all in the bottom, of the tariff scare. And next time we have another downturn, we'll be all in at the bottom and ready to benefit as the market rallies, and hopefully get 18 years, 19 years, 20 years of outperforming our peers.
How are you thinking of tariffs in terms of the impact on portfolio companies? Like, are you guys actually doing like sensitivity analysis to try to figure out what it might look like, or is the policy so uncertain that you're not? Like, explain how that's working into your process, if it is at all.
Well, again, I would say one of the analyses that we did, again, I'm head of investment strategy as well as being CIO. And as one of the things I had to do is try to figure out, just like COVID, where you had to get are we going to have a vaccine? What are the probability of the vaccine? All that kind of stuff. You had to figure out whether these tariffs would really be in place over a long period of time, whether this was a buying opportunity or this was a structural change in the profitability of some companies that make products overseas, right? Or people who import stuff from overseas, right? So we had to do our own analysis. We talked with constitutional scholars, we talked to law school professors. We did a lot of our own internal work. We came to the conclusion, again, much earlier than the market did, that the vast majority of these tariffs will be ruled unconstitutional. We saw the court, come in the first court decision 3-0. It was a 3-0 decision with a Trump, an Obama, and I think a George Bush nominees on that court. So it was something that they all three could agree on. I think the Supreme Court has been very, very emphatic in their rulings that actually four different rulings, all 6-3 decisions that all kind of limit the power of the presidency. It's just a matter of time before the Supreme Court kind of rules against, again, the vast majority of these tariffs. So from a longer term perspective, when we think about tariffs, it doesn't really impact our investment horizon, our investment strategy, or even the companies we're investing in. And again, what we did do is some companies that got impacted by tariffs, we actually added to them with the expectation that a lot of those concerns would go away.
And is that how you look at macro in general? Like, I would think you would probably mostly look at macro from a bottom-up perspective. How does it affect my individual companies? But like your point with tariffs, there's a certain situation where you maybe have a major issue with the market, and we have to look at it from the top down and say what might happen here.
Oh yeah, so I would differentiate between what is when I think about macro. When I think about macro is like, what's GDP going to be? What's the Fed going to do? Those kind of things. What is the difference? What is the euro versus the dollar going to do over the next month or week or day? We don't have a great insight on that. I can try to play armchair economist, but that's not my role, right? I have so limited amount of time, and I want to analyze the 120 companies in the market that I think are the best companies, and I want to find the 60 best of those names, and I want to have all my time, all my team's time, focused exclusively on what I call company fundamentals. Now, to your point, there are situations where there's a big concern in the marketplace, whether that be COVID, whether that be tax policy, whether that be where I think I can get an edge, or on tariffs, where I can get an edge by going deeper than most people can go, and get a perspective on that. That hey, the odds of having a COVID vaccine are much higher than the market thinks in March of 2020, right? The risk of the possibility of tax reform is much higher than the market thinks for these reasons, right? Tariffs are going to go away because of all these all these different cases out there. So I would differentiate that from macro, although I guess they're somewhat interlinked, I would say.
You talked about your process for generating 5-year return estimates before, and how you start kind of on a company by company level. Can you explain how that process actually works behind the scenes?
Sure. There's 5 of us actually on the team who actually, we all are responsible for a certain number of companies, and we build that IR. So my co-portfolio managers, as well as one of my associate analysts, also they help build these models. We talk with them as a team. We build to kind of the 40th percentile. We're not trying to be too aggressive. We're looking at history. We're looking at margins. We're looking at capital allocation, where the company's traded in the past. We're trying to just do that kind of longer term analysis to say, hey, we think Revity has $10 earnings power in 2030, right? And for this mix of assets, what should that multiple be? 30 times, 23 or 24 times, get you price target stocks X. What's the embedded IRR here? Same thing on AMD or NVIDIA. We're doing that on all 120 companies that we actually follow on our team. Again, I do some of those. My other co-PMs do some of those. But it's really just simply looking at a longer-term model, applying a multiple to that. That seems justifiable based on history, not a kind of a long shot, if you will, but something that's very, very justified based on history. And that's really what we do. That's what we've been doing for a long period of time, honestly.
And then when you talk about, like you talked in the Barron's Roundtable at the beginning of the year about like 5% returns going forward, what you're doing is you're rolling all that up to the market level.
Yeah, so it's a great question. So what we do is, for the 120 companies that we actively model, but then once a year we'll go through every company in the market, with exception, like we'll do utilities together, we'll do energy together, we'll do real estate together. But every other company we'll actually come up with, we'll do a what I call a preliminary IR for every company through 2030 and now 2031 this year. So we'll do it, and we'll build that up, right? Bottoms up approach. What is the earnings power of the market in 2030? We think right now it's $404. If we do actually apply a certain multiple to every company, I think we kind of get to an 18 multiple being the right multiple. So that kind of leads you to like a low $7,000 to $7,200, $7,300 price target on the market at the end of 2029 for 2030. And again, we'll update that here in June or July of this year.
And do you think that gives you a more accurate view of the market? Because one of the things you've seen, in the past decades is people who look at the overall market valuation have said the market's too expensive effectively forever. And I think part of that probably has to do with a change in market composition. And I would get your process is probably picking up that change in composition where maybe some of these other things are not.
I think that's a absolutely wonderful point. And that's exactly the reason why we do what we do. If you think about 06. So 06, the market was trading about 15 times earnings, right? But the problem was 45% of the earnings for the market came from energy, financials, and materials. Almost half the earnings. And those three sectors are very, very volatile from an earnings perspective. And most banks trade for 10 times earnings. Most insurance companies trade for 10 times earnings. Most chemical companies trade for 10 times earnings, right? And so you've just had a mix change, right? We don't compare the Baltimore Orioles of 2006 to the Baltimore Orioles of 2025, right? There's different constituents, different players. And even, a company like Microsoft today, which is obviously the largest company in the S&P 500, is a very, very different company than it was, back in 2006. Actually, back in 2010, you might have said Microsoft was secularly challenged. Apple's a very, very different company than it was, a much bigger service mix. So we adjust for all those micro factors, and that kind of helps drive a true bottoms up that adjusts, to your point, that challenge. That again, if you're just looking at the history of the market is not constant. The market is a living, breathing entity that is always changing, and we're just going to try to adjust to that change.
Do you have any view? One of the things we've talked about a lot on the podcast is the impact of passive investing on the market. And this idea that as more and more people are putting money in passive, they're using these passive vehicles in their 401ks, you've got these flows into companies which don't care about fundamentals. And if the biggest companies if their liquidity is not scaling with their market cap, this could be driving the biggest companies up relative to the other companies. Do you have any thoughts on that, if there's any truth to that?
Well, see, it's again a very good question. What I would tell you is, I would put passive together with active, right? So if you look at flows from passive and active together into the equity market, and you look at the equity market, the U.S. equity market capitalization today, I would say that passive plus active flows are not different than they've been historically, right? To your point, the mix of passive, it has changed. But again, unfortunately, in the industry we participate, a lot of active managers, they chase the benchmark. So whether it goes into passive, whether it goes into active, the trend is the same from my perspective, right? But to your point, I do think there is a case to be made that passive, I don't think it drives. Microsoft is not overly benefiting today because of passive. Microsoft has a massive market cap. The flows relative to its market cap on intraday are not moving it. Fundamentals still move Microsoft. When Microsoft has good quarters, stock goes up 10%. If a tough quarter, stock goes down 5%. But I do think the market is becoming less efficient broadly, even if it's not necessarily flow driven, because if more investors are making decisions based on, hey, I want to own more financials, as opposed to I want to own more JP Morgan or I want to own more ICE. If they're making those kind of investment decisions, there's more inefficiencies, right? We saw that, when Trump was elected the first time, everybody wanted to buy financials, and the financials ETF really took off. But what's in the financials ETF are some companies that have nothing to do with higher rates, like insurance brokerage companies, or real estate was part of the financials index, which actually probably should have a negative correlation to higher rates. So sometimes if more people are making decisions, like I just want to buy semiconductors, I'll buy the ETF, or I just want to buy financials, or I just want to buy, or don't want to buy healthcare, you do see a situation sometimes where stocks get dragged along where they shouldn't, and that creates opportunity for us. If Hillary Clinton is tweeting about healthcare and drug prices, she's not tweeting about Zoetis, which makes medicine for dogs, cats, and birds, I guess. So there are, but when she tweeted about that, Zoetis went just down as much as Merck and Pfizer and all these other. And so there's opportunities created by passive, but I don't believe valuations are excessive today, driven by passive or driven by flows. In many cases, some of the biggest companies in the market actually are trading for lower valuations than they've had historically, with the exception of Tesla. I think almost all the other Mag 7 trade for lower valuations than they have historically.
So you see it as creating dislocations that you as an active manager can take advantage of over time.
Absolutely. Again, we've actually written a paper on this. Again, when you see excessive flows into ETFs, into one sector, companies become more correlated than they should, and that creates opportunities for us to take advantage of it, either selling something that's going up for the wrong reason or to buy something that's down for the wrong reason. And again, we see that all the time. Sometimes, again, NVIDIA has a good quarter and the semiconductor index goes up a lot. There's some companies that have really very little to do with NVIDIA that go up for no reason. So we'll take advantage of those opportunities.
Do you think there's anything to the idea that as an active manager, you might have to lengthen your time frame because of it? So if these passive flows are going to continue, they may create these dislocations for longer than they have in the past, and maybe you have to think a little longer term. I know you think long term anyway, but do you think there's any truth to that?
I think there is truth to that. I think there is truth. And again, we like you say, we do have a longer term horizon. And again, what's interesting though is like even some of these anomalies, right? They tend to correct themselves relatively easily. Again, that situation I mentioned with Zoetis, where it went down just as much as Merck and Pfizer and all the other drug companies, that reversed itself, very, very quickly, right? So maybe some of these aberrations, these passive flows are causing things that may have a little bit longer duration to them. But again, some of these passive flows can be really, really positive, really, really negative, really, really quickly. So, again, we take that little longer term horizon around these passive flows. And again, the market, I would say one thing is definitely true with passive flows is there's very, very few people in the market that are doing what we're doing. When I got into this business, when I first became a portfolio manager in 2006, there's a lot of people I think were having a longer term horizon, that 3-year horizon, a 5-year horizon. Let's find companies that are out of favor today that are going to do well over the next 3 to 5 years. I think just so much of the intellectual capital of our industry is spending all of its time on essentially trying to figure out the next quarter, the next data point, this industry is becoming more and more short-term focused, right? How many cars are in the Home Depot parking lot from satellites, right? What's the latest credit card data on this company or that company, right? And it's that information, if everybody has it, it becomes very, very efficient. So you're trying to have an arms race in the least attractive part of the market, right? And we just don't play that game, right? If Home Depot's down 3%, it's probably because there's some kind of credit card data that everybody has access to that has very little impact on longer term trends anyway.
I'm just curious, is there any of that more advanced data that you have found valuable, like as a long-term investor? Is there anything like outside of the standard fundamentals that you have found valuable in your process?
Actually, we've looked at almost everything. I would honestly say almost nothing.
Interesting. And do you think, you probably don't operate very much in the small cap space, given the size of your fund, but one of the arguments David Einhorn made a while back is that not only do we have the influence within the S&P 500 of this flows, but in the small cap space, nobody's just paying attention anymore. So he had made the comment that, when he sees good news about his company, it just doesn't react like it used to. We don't get the multiple expansion anymore because no one's paying attention to that kind of stuff. Everybody's just in these passive, big indexes. Do you have any thoughts on that idea?
It definitely could be true. Again, I don't spend a lot of time on small caps. The one thing I would say, and I don't want to, the small cap index, a lot of people look at it and say the small cap index is really, really cheap. But if you really look at within the small cap index, again, how these indexes evolve over time, there's a lot of banks, there's a lot of real estate companies, a lot of REITs, a lot of insurance, a lot of energy, I think most of the small cap indexes, about 40% of the companies actually lose money, right? So people look at the multiple, and the multiple's not that high, but if you adjust for all these companies that are losing money, so it's what I've looked at historically when I've talked to our small cap managers here at Rowe Price Investment Management, what they'll tell me is you look at a good small cap industrial, it trades just like a good large cap industrial. If you look at a good energy company, it trades like an energy company, right? The banks trade for similar multiples of banks. I think so. It's a lot of it's this mix, and you have all these really horrible companies that kind of skew the index that don't make any money and tend to underperform systematically. So maybe the market's being less efficient there, but again, at least from my discussion with our small cap managers, they don't see that. They don't see dislocations that would say company has good fundamentals, they beat the numbers, and the stocks go down. It's usually not how it works.
Going back to your individual company evaluation process, has that changed at all given the composition of the market we talked about earlier? Like, for instance, many people who call themselves like traditional value investors completely missed the Mag 7 because those standard value metrics didn't take intangibles into account, and they just missed the value that was there. Like, has your process evolved over time? Because I know you have owned a lot of those companies and done well with them. Like, how do you think about like how your process has evolved because of more intangibles in the economy?
No, I think it's a good point. It's definitely a good point. And part of the issue from if I take a step back, we always want to continue to get better at everything we do, right? We always want to learn. So when I first got into this, I had been kind of a value person. I'd covered industrials, I covered a lot, building materials, autos. I kind of grew up at T. Rowe as a value investor, right? But this idea of trying to always get better. Okay, let's think about let's think about the valuation for Amazon. Is it really that illogical if you look out 2 or 3 years out, right? Let's look at life science tools, an area that would not traditionally be a value sector. Let's think about managed care, which maybe is a little bit more of a managed sector, but not all the companies are in that sector are kind of value names. So our process is always evolving. At one point, we had a kind of 18-month IRR. Then we evolved it to 3 years and 5 years. We added more tools to that toolkit, adding doing the S&P 500, every company in the market. That's a new thing we've done new. So we're always trying to get better to that process. But I think the building blocks of building a really good model that is logical, sustainable, putting what is that earnings power of the company in 2030? What is that earnings power 5 years? That is the same process today that will run for NVIDIA or AMD or Ameren or NiSource or any other companies we own, right? Whether it be utility, whether it be a consumer staple company, it's the same process completely.
Do you think there's the conclusion of that process? I mean, a lot of people from the outside right now are comparing this situation now to the late 90s and saying just tech is completely overvalued. But it seems like you own a good amount of tech. So does that process lead you to believe that tech is not as overvalued as many people think it is?
When I would divide tech up, and maybe we'll talk about the Mag 7, but there are clearly companies in the market in tech that are crazily overvalued, right? Palantir at 250 times earnings. The assumptions you would have to make to say Palantir is an attractive investment here doesn't make any sense, right? Tesla losing share in U.S., Europe, China, way behind in autonomous vehicles. Just kind of. Tesla could fall 95% tomorrow, and I wouldn't buy a share of Tesla. So, but there are other things like Microsoft, a very, very reasonable valuation. 30% revenue growth, 15% EPS growth or total return. Very, very attractive. Software, which was kind of an area, especially vertical software, which is an area that kind of was left by the wayside last year because everything was about AI. There's some great software companies that are trading for very, very reasonable multiples today. So. It's just depending on where you look. Yeah, there's ServiceNow is expensive, Tesla's expensive, Palantir's expensive, but there's some really good companies that are very, very reasonable value within software. Whether you're talking about a PTC, whether you're talking about a Workday, even a Microsoft and Amazon, we see actually really good value. It's funny, Amazon trades at a discount to Walmart today, which again makes no sense whatsoever. So. I would actually argue some of the places in the market that are most expensive, most overvalued, Costco. You could actually say, Costco or Walmart. Costco at 50 times earnings, Walmart at 35 times earnings. Those don't, for companies that basically grow earnings at 8 to 10% a year, that seems very, very illogical to me.
Do you have any views on comparing and contrasting the tech bubble to today? I mean, you'll have some people who will say they're similar situations, then you'll have other people say like these big tech companies are really, really good companies that trade at much more reasonable valuations than say like a Cisco did back then. Like,
Yeah.
do you have any feelings on the comparing and contrasting those two periods?
I don't think it's just not a fair comparison because you're right. I think Cisco traded for 500 times earnings at the peak. EMC, I think it traded 1,000 times at the peak, right? These kind of crazy valuations. And again, with the exception of Tesla, maybe with the exception of Palantir, for the most part, you look at Microsoft at 30 times earnings, you look at Google below 20 times earnings, you look at Meta in the low 20s. The multiples are so different from what we had back then. What drove last time was kind of a unsustainable Y2K technology kind of boom, right? And then, it was really actually very much of a telecom boom in many respects. What's going on today is a lot more sustainable around the cloud migration, around software, replacing people with AI. I think that's a lot more sustainable longer term.
How do you think about using history like that? Whenever we see a situation in the market, people will always go and try to find some analog in the past and say it's just like that. Like, do you do any of that? I mean, I know you're kind of going from the bottom up, so that may not matter too much to you, but do you think at all about looking at past periods and like what you might be able to learn or how you might be able to compare it to today?
Absolutely, absolutely. And this maybe where we kind of use our, we kind of do a lot of quantitative work as well. So, and again, one of the things, and this, yes, one of the things we look at is we know for a fact that based on history, every time the market goes down 10% and you buy stocks, your expected return over the next 12 months goes up by about 200 basis points. So by actually buying stocks down 200 basis points based on history, your expected return goes up by 200 basis points. Your risk of loss goes down by 500 basis points. If the market goes down 15%, it gets better. If the market goes down 20%, your risk of loss over the next 1 year goes down by basically half. And your expected returns go up about 50% relative to what they would have been otherwise. When VIX spikes, again, when most people are selling and we're buying, that's an environment where, the returns can be as much as 2 times normal when VIX hits a certain level. So we are students of history. But I think, but maybe where you're going with the question a little bit is there a situation where like this environment is just like the dot-com bubble, or this environment is just like the Nifty 50? My sense is every situation might feel a little bit alike, but in reality, given how the companies have changed so dramatically, how the composition of the markets changed so dramatically, the similarities are small as opposed to big.
I wanted to ask you about, as looking at your evaluation process and the types of things, the attractive opportunities to find, I wanted to ask you about both sides of that. So what are you finding attractive right now?
We mentioned software. Software is really, really attractive today. These vertical software companies that kind of grow revenues at kind of the low to, high single digits to low double digits, grow, EPS in the mid-teens. And these are companies that, for most of the last 5 or 6 years, these were companies that kind of traded for 25 to 32 times earnings, right? And today, because AI is all in the vogue, it's kind of been, like I said, left by the wayside. So you're able to buy great companies for, let's call it low to mid 20s price to free cash flow. It's funny, some of these companies traded, discounts to industrial companies that have 1/3 of your revenue growth, half the EPS growth, and a lot more earnings volatility, much less recurring revenue. So, whether, again, like a PTC, a Workday, these are great companies that trade for very, very attractive valuations. And I think over time, the compounding effect of their earnings growth plus multiple expansion will generate kind of mid to high teens kind of returns. So that's one area that looks really, really attractive. Healthcare has been a horrible area, as you guys both know, over the last 2 years. And I think, valuations have come in a lot. And I think we see a return to normalcy probably as we kind of go out to 2026 in managed care, life science tools, parts of med tech, and even parts of pharma. I think we will feel a little bit better about all 4 of those segments probably as we go into next year for a variety of different reasons we can get to if you like. But I think, again, fundamentals probably getting better, low valuations, all companies that we think can kind of grow earnings at kind of the low double-digit rate over time, if not faster. And again, and we look at it kind of mid-teens kind of IRRs on a lot of those names. So we really like healthcare. The last area I would say is that we really like is utilities. Utilities are not your father's utilities. From 1986 to 1998, utilities had zero earnings growth. I mean, like for over a decade, zero earnings growth. But today, because of renewables, grid investments, hardening grid, and more recently, EVs and data center needs for incremental power demand for this country is inflecting positively. And you have utilities that historically kind of grew earnings in, let's call it the 5 to 6% rate. There are a lot of utilities that we think will kind of grow earnings, let's call it 8% plus. A C&P, a Centerpoint Energy, and Amren's kind of an 8% kind of grower, a NiSource 8% plus grower. When you start growing earnings at 8%, you have a 3% dividend yield. That's a return that is probably greater than the market over time. Your multiples have come up a little bit off the bottom, but they're still really, really attractive relative to where they've been historically. So again, if I can give you an algorithm, EPS plus the dividend, that's in the low double digits with no FX risk, no economic risk, no currency risk, that seems really, really attractive. So, Centerpoint, Ameren, NiSource are some of our favorites on that list.
How about on the negative side? Are there any sectors you're less optimistic about right now?
I think the one sector that strikes us as a little bit overvalued is financials. Again, if you look at a lot of the big banks, a lot of the big banks, it's traded in a range of kind of 9 to 11 times earnings over time. And today they're kind of trading at the very high end of the range, let's call it 11. And some companies are actually 11 to 13, 11 to 14 times multiples. The price to book on some of the companies are actually at the high end of where they trade relative price to book relative to the market. And so I understand the short term, because again, right now we're in a nice spot. Rates are high. Net interest margins are still expanding. We don't have any, it's not any big credit losses right now. But again, what we've learned from cyclical investing, actually going back to my days being an auto analyst, being an industrials analyst, you typically don't want to buy cyclicals when fundamentals are really good and valuations are high. You want to buy cyclicals when kind of fundamentals are a little bit shaky and valuations are attractive. Making money in cyclicals, so the easiest way to make money in cyclicals is just buy things that are out of favor, like we did in 2022 with both banks, insurance or banks and industrials and other cyclicals back in 2022 when everybody thought we're going to be in a recession, right? You don't want to buy financials when everybody thinks things are good.
How do you think about management in your process? We've had some investors on the podcast who say, we just like to look at the results. We're not going to get the truth from management, so we don't talk to them that much. And then others who say talking to management is everything. Like we really want to learn everything we can about management. How do you think about management in your process?
It's somewhere in the middle. It's somewhere in the middle. Again, I think one of the nice things about being here at Rowe Price Investment Management is we have great access to management teams. And so we want to talk to them about their business. We want to talk about where they see the opportunity for margins. We want to talk to them about their strategic positioning. We want to talk about them how they're going to be taking market share. We're talking about the threats, how they can benefit from AI or be hurt by AI. We want to talk to them about sometimes we want to talk about them how do they deploy capital, right? One of the big market efficiencies there is how companies deploy capital. We want to have every discussion we have with the management team, we talk to them about how they're deploying their capital. Are they buying back their stock? Why not? Are they going to want to do deals? Are we do small deals, big deals? What's the right multiple for deals? So again, we will have interactions with every management team that we own. Either we cover as a team or we own in the portfolios, usually about 5 times a year. We'll see them at a conference. We'll see them post earnings calls. That interaction with management, making sure that they're doing the right things to create as much value for our shareholders as we possibly can.
I'm curious, when you look back at the biggest winners of your career, do you think having really strong management is one of the most important criteria in having them become winners?
Absolutely. I think that's, if you think about, Fiserv under Jeff Yabuki, you think about the leadership at AutoZone, you think about Mark Cafford done it at Thermo. Think about all the names that have kind of been these GARP stocks that were we bought them in 2010, 2011, 2012. They were kind of trading at, low teens to mid-teens multiples. And they kind of compounded earnings at a low double-digit pace. But over time, the companies became better. Usually because they deploy capital really, really wisely to grow earnings, to grow their top line, to improve the organic growth rate of the company. And over time, they got rewarded with that in a higher multiple in almost every case. And that's how you turn kind of low to mid-teens earnings growth into high teens, even low 20s kind of total shareholder return. So, it's actually, we will never invest with a company that has bad management team. We will literally, we believe you are a bad management team, you are destroying value, we will not invest with you. This is one of the 6 criteria that we use to, basically eliminate things we're going to spend time on.
What would be some of those other criteria that you would use as elimination criteria?
Sure. So we will not invest with, again, bad management team, bad cap allocation, a company undergoing secular challenges to their business model or their top line. A company that has an extreme valuation like a Tesla or a Palantir, or a company that can't generate over a full cycle, let's call it a high single-digit total return algorithm. That's the EPS growth plus the dividend. While very, very few companies claim to have an algorithm below high single digits, if you look at over time, somewhere between 25 to 35% of all companies in the S&P 500 can't deliver a high single-digit kind of total return algorithm over time. And so we want to avoid those companies. Again, the Staples Index over the last decade has grown earnings at a 4.4% CAGR. They still trade for very, very healthy valuations, and yet they're going to grow half that of their earnings will grow at half that of the market over time. So again, we're going to choose to buy utilities over staples, right? So if we don't believe you have a good chance of being able to generate that high single-digit kind of total return, we're just not going to invest with you. We're not going to consider you. We're not going to think about you.
You mentioned some of these, but who do you think, you've seen a lot of management teams over your career, like who do you think are the best CEOs you've seen in your career?
The best CEO, I think, I would put a couple of people in that category. I think Larry Culp. I was the analyst covering Danaher many years ago. An amazing job of transforming Danaher's portfolio, great earnings growth, and basically coming in and saving GE. I mean, GE, if nothing had changed there, I mean, Jeff Immelt destroyed so much value over his career. Larry came in, Carolina came in, his CFO, and really turned that company around today. It's kind of crazy to think about it today that GE trades for 41 times earnings. It's a really it's a very, very well loved stock and was very, very hated. So he's done an amazing job of turning that company around, not only from a business perspective, but from a cultural perspective, a capital allocation perspective, a cash flow perspective. So I think Larry would definitely fall into that group. Mark Casper at Thermo Fisher, he's done an amazing job. He's been there almost, 15, 16 years now. That was a 4% organic growth company that he kind of took to a 6 to 7% organic growth company. Again, compounded earnings at a strong double-digit rate, and he made the portfolio stronger over time. And again, just an amazing CEO that I was able to invest alongside with most of my career. And again, I would go back to the last person, is Jeff Yabuki at Fiserv. Again, a great CEO. Business got a little bit better every year. Margins got better every year. Bought back a lot of stock, and just compounded wealth at a high teens rate during his career. And so those are the kind of, and what's really unique about all those is they use cap allocation to make their business better. They did cap allocation really smartly. And by doing that, the market over time rewarded them a higher multiple. And maybe the last person I would just mention is the late Brian Jellison at Roper Industries. Again, I was the analyst covering Roper. I owned Roper as a portfolio manager, but again, a company that took a company that was really a pumps and valves company into today what is basically a medical and software company today that, again, and he compounded wealth at a high teens rate. And again, he found a niche in the market, buying kind of niche businesses that didn't fit anybody else's portfolio, and created a tremendous amount of value. So those four guys, I would say, are the kind of the poster men or people for value creation that we look for. We look for when we find those kind of people, those kind of characteristics. Is Prahlad? I think Prahlad Singh at Revities has that characteristic. And I hope when I'm on your show in 5 years, we're talking about Prahlad being in that same category. I think he has that capability. Those would be the names I would mention.
Just one more for me before I hand it back to Justin, and I have to ask this as I'm a quant guy. Like, how much does quant play a role in your process? I mean, do you use it for initial screening to generate ideas? Do you use it for risk management? Like, how much do quant processes play a role in what you do?
It's really, again, we have a very strong partnership with our quant group here at Rowe Price Investment Management. And so some of the stuff we've kind of developed some proprietary kind of measures. Again, we're very, very focused on downside risk. So we've created some downside metrics of downside risk with everything in the portfolio to try to help us understand like how much we would lose if something bad happened in the market. So we work with them on those fronts. I would say we do want to have a portfolio there's certain factors that we want to have overexposure to because we know they generate really good returns. We want to have companies that have low earnings volatility, low EPS volatility. That is a factor that tends to generate very good risk-adjusted returns, very good absolute returns. That factor tends to work in a normal market, you outperform. In a down market, you outperform dramatically, and even in a big market, you underperform, but not that much, right? So it's a really good factor that we spend a lot of time. So we work with our quant group on that, but we also use our quant group to help us identify things about the market, right? We think about the economy. The economy is very, very mean reverting over time. If you think about it from an ISM perspective, and some of the analysis they've done to help us understand that mean reversion and how we can take advantage of that, it's really, really helpful. Hey, the market's down a lot. What do you want to buy? You want to buy, you want to buy information technology. You want to buy industrials. You want to buy consumer discretionary. You don't want to buy healthcare. You don't want to buy staples, right? The market's, the ISM is really, really high. What do you want to buy? Yes, you want to buy counterintuitive. You want to buy utilities. So some of that really good quantitative work we have here, led by Farashugi, helps us understand what the market's doing and where we should be positioned. And sometimes that's counterintuitive, right? If I come on your show or if I talk to someone and I tell them, they say, hey, the economy is doing great and ISM's at 58, what are you buying? I'm buying utilities. It sounds kind of crazy to say that. That's not, that's not what you want to hear, but that's actually the right answer. And we're very, very much focused on getting the right answer as opposed to getting getting what sounds good.
So I've heard you talk about the earning the right to take risk. What does that mean in practice, and how do you apply it when you're building your portfolios?
It's funny that you mentioned. I'm not sure. I don't remember having said that, but I could be wrong, or someone might have misquoted me. But I think that the heart of your question is when we're taking risk in the portfolio, we have lots of options, right? We can go and buy. I can go buy a BB bond in the marketplace of Yum Brands or Hilton. This is basically zero risk of default, and I can earn X. And the volatility attached to that product, that bond, let's call it 5 or 10% of the market's volatility, right? I can go and do that, right? Or I can go buy a single B credit, that has maybe 100 bips higher yield, and I can get this yield, right? And we are constantly looking at the portfolio and like where between high yield, investment grade, leveraged loans, treasuries, a utility that has half the beta of the market, or do we want to buy Nvidia where it has a 1.4 beta of the market, right? We're constantly thinking about where is the best risk reward in the market make place. Not just focused purely on upside, but where is the best risk returns. So like when we go through this IRR process, I get a report every morning that we put together that shows like the IRR for everything in the portfolio, equities, fixed income, and we basically make a determination, okay, that has a higher IRR, but what's the risk profile? So we're trying to find situations where good IRRs, but also the range of outcomes is more narrow. Now, you can't do that with NVIDIA, you can't do that with AMD, but you also manage position size and the risk profile by doing that.
I think you sort of hit on this, but I want to ask it again, just to see if I can flesh anything else out. So over your career, what do you think is the biggest sort of change that you've seen in maybe investment management or investor behavior over time?
It's just this focus. There's so many smart people in our industry. There's so many great firms in our industry. And just as I see, when I go to meetings with management teams, with broader investors, the focus is so short-term focused, right? It's just so short. If you look at hedge fund net equity exposure, it's like a roller coaster. Like the market's really at the peak, and they're at the peak, and then the market goes down, and they're at the bottom, right? It's just, everybody is so short-term focused. Everybody's on the next data point. And again, I think the history would show that is a losing strategy. That part of the market is becoming more and more efficient. The ability to have anybody has like a proprietary data that gives them an advantage on Home Depot's comps or something like that. I just think that's a losing game. It's just not the game we're going to play. And so, again, like I said, when I got into this business, I think there's a lot of investors. When I go into investor meetings, we're asking the longer-term questions, the 3 and 5 year questions, focus on capital allocation as opposed to like everything's about what's happening right now, and obsessed with I can't buy that stock because I can't buy industrials because Jamie Dimon says we're going to a recession, right? Well, industrials in 2022 we're already pricing in a recession. Semiconductors we're already pricing a recession. It's already in there, right? So I think the market has become more efficient in the short-term aspect of the market, but it's become less efficient in the longer-term focus. And actually, to the earlier question, maybe some of that's also passive, right? Some of that's also passive where people are, making investment decisions based on that are exposed not at the stock level, but at the sector level, even at the market level.
Have you given any thought to the impact of AI, both on the economy and your portfolio companies, but also sort of from an investment standpoint? Is the firm looking at some of these new technologies and trying to figure out, or maybe it already is using some of these in the investment process?
I would say one of the examples that we use for AI is we have, I use daily something called FactSet, which maybe you or some of your listeners would be aware of or familiar with. But it's basically, it has a lot of data, it has all the sell-side research, has all the historical financial information, transcripts, all that stuff. I spent a lot of time on that. And for the first, 25 plus years of my career at Rowe Price Investment Management, I spent a lot of time looking up things in FactSet. What did Microsoft say in their transcript about the size of the security business? And I would go through 10 transcripts trying to find that piece of data, right? And today, we have the ability through FactSet and through FactSet plus Perplexity, I can kind of type in something that I want to know, and I can find that really quickly. So data retrieval is a lot better today than it would have been, a year or two ago. So we are using that. We can search our own internal research here at T. Rowe Price, as well as finding sell-side research or going through transcripts. So that does make us more productive. But I would say it makes us more productive, but it's not a game changer in terms of our productivity. We do think AI will be disruptive to the economy. I think long term, 5, 10 years out, AI will likely cause the unemployment rate in this country to be structurally higher. And what are the implications for that on, if you have a supply, we've basically been in the last decade, a supply-demand imbalance for workers versus the demand for workers, with the exception of a couple of short periods of time. I think AI will make that analysis a lot harder on workers, right? People who are going to work every day. And the average computer programmer today makes $110,000 a year, according to the census data. You can today replace a computer programmer for a $19 subscription to GitHub Copilot that can do that program. Can replace one of every 4 programmers for that kind of cost. So, I think there will be structurally higher unemployment. That probably puts downward pressure on inflation. That probably puts downward pressure on bond yields over a long period of time. So that's one of the longer term implications. But we are going company by company at a micro level and saying, okay, how does AI impact your business? Does it impact it in a positive way, a negative way? Does it help your margins? Does it help your revenue growth acceleration? And for a lot of companies, I mentioned software. Software is a great example. Software, if you can do more with less programmers at lower cost because of GitHub Copilot, your margins go up, or you can spend more on programming, or you can add kind of AI kind of plugins to your software that make sure your people who use your software more productive, and you can kind of have a double whammy of higher revenue growth and higher margins, especially when you look at low multiples today. That seems like that will create a lot of value.
I know you personally aren't responsible for managing any portfolios with international stocks. At least I don't think so. But at a firm, obviously, there's international strategies. And, finally, after a very long time, international, at least so far this year, broadly speaking, is outperforming the U.S. And I'm just wondering, as the CIO, do you have any views on sort of international versus U.S. in the context of building a globally diversified portfolio? Just because I think the last 15 years, the U.S. has just been such a hard market to beat. And I think a lot of investors here in the U.S. are probably mostly invested in U.S. stocks. So I'm just wondering your thoughts on that.
Well, I think it's a great question. Again, let me approach this at a micro level. What I would tell you is many years ago, I had a portfolio that's mostly U.S. securities, and I found all these great GARP stocks, these 120 stocks that we look at. I said, why don't we go out internationally? Why don't we actually do an analysis? Why don't we, as a team, let's look at Japan, let's look at Europe, let's look at Australia, let's look at Canada, and let's see. There's got to be some really great companies that we can invest in those markets, right? And the reality is, after having gone through over 1,000 companies in those 4 markets, the answer was there's very, very few really great companies in those markets. No Mag 7, no Mag 6, very little life science tools, no managed care. Very little software, but what we found a lot of banks, found a lot of bad banks. We found a lot of insurance companies. We found a lot of energy companies that don't want to be energy companies anymore. We found utilities that don't look like our utilities, have a lot more earnings volatility, right? So this goes back to the micro comment. You know, you don't need to buy an inferior index filled with inferior companies just a global diversification, right? There's a reason why these companies, these indexes trade at a lower multiple than the U.S. Again, lack of Mag 7, lack of a lot of software, that's all true. But they also just have a lot of bad companies. They have a lot of, financials, materials, insurance, banks. These are all low multiple sectors, right? So when someone says, hey, European index is trading at 16 times, the U.S. is at 20, but you're comparing apples to oranges, right? It's like comparing the '06 market with 45% financials, materials, and energy, today's market where that's like 2,000 basis points less. So again, what I would say, you can, a lot of the companies that we invest in today have half their revenues outside the U.S. You can buy globally diversified companies with great capital allocation, great management teams. You don't need to go out and buy an inferior index to do that. I think a lot of the underperformance this year in the U.S. is really a function of, okay, we came in at really high valuations, and maybe the U.S. dollar was a little bit overbought, and then our president put in place some policies that were very disruptive. I don't think any of those things are things that we're going to be talking about in 3 to 5 years. And the reality is, if you look at the European index, earnings growth of the European index is half that of the U.S. too, as well. So it's just, I think micro level, index level, we still favor the U.S. We own C&Q. C&Q is an amazing company. It is a Canadian-based oil sands producer, best energy company, best capital allocation I've ever come across. A great management team, like I said. But it's a Canadian company, but we're happy to invest in it. We own it. We own ASML. We bought ASML after the stock fell from 1,100 to 600, right? And it got really attractive valuation. So we will own some non-U.S. companies, but it's really few and far between. And just I always encourage people to think about when you buy a European index, what are you getting? When you buy a Japanese index, what are you getting? You're getting slow growth, bad management teams for the most part, and not a lot of earnings growth.
Well, I think your point about focusing on the micro is so important, and it just kind of reminds me, with any ETF, well, most transparent ETFs, which most of them are, you always have the ability to go and look at the underlying holdings to sort of see what you're getting, and that's to your point. I think a lot of investors just don't do that, and it's just like, I want to buy this because it's like got this return over the last 12 months. They're not actually thinking about what's inside the ETF or what's inside the index and what's driving it. So that's an excellent point. So in closing, we have 2 standard closing questions, if it's okay to ask you, Elise, for the next couple minutes. So the first is, what's one thing you believe about investing that most of your peers would disagree with you on?
I think that the thing that many investors would disagree with us on is that being a macro investor is something that can create a lot of value. I think that would be the thing that I think, I have limited time. We're gonna spend time where we can have a competitive advantage, that long-term horizon, 120 companies. I think I've been around doing this for a long time. I've heard a lot of people talk about the Fed. I don't know if I've ever heard anybody say something about the Fed that actually ended up creating value for shareholders, creating value that you were able to make that an actual insight, right? Every year someone calls a recession, right? And they're 90% of the time they're wrong. If you get, I think I have a much higher odds of getting the earnings power right on Rivity or Microsoft, getting that right and having an edge on that with the longer-term horizon than trying to predict what the GDP is going to be. There are economists who spend 50 hours a week. How am I going to do a better job than some economists on predicting euro-dollar relationship, GDP? I'm not qualified to do that. And to become qualified, I'd have to turn away from all that micro analysis where we do have an edge. So I just tell my team, let's focus on where we have a competitive edge, where we can find differentiation and create value for our shareholders.
And the last question, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
A stock, an ETF, a mutual fund is not good or bad because it went up in the last 12 months. The stock's going down you should be willing to take your risk profile up. Like just like we have done consistently every time there's a market. It is amazing to me how many really intelligent investors, market goes down 10%, they get scared. You shouldn't get scared. You should actually be, nothing, for the most part, nothing, for not every stock, but if the market goes down 10%, it's usually a good buying opportunity. The odds are in your favor. And so we see investors time and time again selling at the bottom, right? Coming in after the market's already rallied 30%, right? And I just think that is that is a recipe for value destruction at an individual or for a portfolio, for an institutional portfolio manager as well. If you're or a hedge fund, if you're consistently like all in at the peak and have very little exposure at the bottom, then you just replay that over time, you're going to destroy a lot of value for yourself or for your clients. And again, like I said, we've created a lot of value over time, basically doing the exact opposite of that.
Thank you very much for joining us, David. We really appreciate it.
A great discussion. Great questions, guys.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.